My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make you a little money. My job is not just to entertain you, but to educate, to teach you. So call me at 1-800-743-CNBC. Tweet me, Jim Cramer. All right, look, people, we're losing some themes, and that's causing trouble for this market. Even as the averages were basically flat today. Dow dipping 65 points, S&P inching up 0.23%, and the Nasdaq advancing 0.34%. It's narrow. Unless more companies and more sectors start doing better, you aren't going to get the kind of healthy breadth that so many investors want to see before they dive in. Now, we've had a terrific market for most of the year, but many, if not most of the people I talk to, believe the rally is unsustainable. They think we'll have to pull back unless things broaden out. Now, we know the rally is driven by a handful of stocks: NVIDIA, Apple, Microsoft, Alphabet, Amazon, Oracle, and now Broadcom, which we own from my Chapel Trust. We put out a bulletin to all club members that told the tale. Broadcom's equipment is integral to generative AI. It makes much of the plumbing that goes into the data center. It has many other tech businesses, including a very big telco division that's been in the doldrums for ages. But Broadcom's incredibly strong artificial intelligence revenue, $3.1 billion, up from $2.3 billion the previous quarter, totally outshone anything negative. As we told members of the club, its AI-related business saw a continued surge in sales. Management raising its full-year outlook to $11 billion, backing up our view that this is one of the best AI chip stocks in the market. And that's how this $770 billion company that you may never heard of could jump more than 12% today. Oh, that and the 10-for-1 stock split that's designed to make the stock more enticing to home gamers hasn't even happened yet, and it's already working. So, as usual, there was the pin action from a major tech company that reported a good number. NVIDIA rallies 3.5%, Dell up 2.4%, Arista up 6.5%. Third happened to be Broadcom's partner, Micron up 1.7%. Tech might continue to lead tomorrow as Adobe, which is on later in the show, reported a stellar quarter. This is that graphics company that does actually so much more than graphics. It gave you an excellent forecast. Like Broadcom last night, this stock is soaring in after hours trading. We can have an exact repeat of what happened today. Bears and tepid bulls dislike that this market's led by a handful of tech stocks. Look, I don't blame them. I prefer to see many more sectors participating. Sure, that would be great. The problem is that they often can't participate because of issues in their sectors that make it difficult for you to own their stocks without the potential to lose a lot more money than you do if you own tech. So let me take down some of these issues so you know what I'm talking about and have a better idea why we are not broadening out, and then make a decision whether you want to be in tech. Because of the issues that I'm talking about, you might not want to be in the others. Let's start with the banks. This group, a bellwether sector for the market, had been producing some really solid gains ever since we realized the Fed was done raising interest rates last fall. We got solid beat and raise numbers when they reported their first quarter results. But this week, the winning streak ended, and it ended in a very strange way, an unnerving way, frankly. Huntington Bancshares, HBAM, one of the best regional banks, cut its forecast because of what's known as lower net interest income, or NII. This was totally out of the blue, people. Just this week, Huntington's CFO traveled with UBS to Europe and told a really compelling story. Earlier this week, the same CFO went to a sector conference and said net interest income guidance would come up short, projecting it to be down 1% to 4%. Previously, it was supposed to be flat, maybe somewhere between plus or minus 2. Now, that may not sound that much to you, but when you think everything's fine, you get gaffe like that, you start thinking, Huntington, it can't possibly just be Huntington, right? Who else is to cut numbers? Someone else is lurking. That's why investors collectively decide to sell the banks first and ask questions later. Why take the risk with the averages at such high levels? Now, I personally think Huntington will prove to be an aberration, but it doesn't matter what I think personally. What matters is that stock, which was about $14.25 a month ago, is now at $12.34. That's a roughly 13% decline. So for the moment, nobody wants to go near the banks for fear that they'll have a Huntington on their hands. Second, healthcare had been a reliable group until very recently when it started rolling over. Once again, I like the stocks down here. We're doing a week-long series of the most attractive growers in pharma. They're what you should be buying in a slowdown where inflation is going lower. That could be could fit our description of our market. But last week, we got a very strong employment number, robust hiring. So we don't know the direction of the economy overall. Without any degree of certainty and no call from the Fed saying the slowdown is imminent, the recession-resistant healthcare stocks have been getting hammered. I think you should buy the weakness. I already recommended AstraZeneca, Merck, and Novartis earlier this week. I got another one later tonight that has a good dividend, still one more tomorrow. Now, I like these kinds of stocks, and more important, I like to buy them when they're going lower, not higher. But again, sadly, that's not what most people like to do. They like to chase. I don't like to chase, but most people do. Third, there's the transports. Now, this is a fulcrum group that does have me concerned because the transports are trading like the economy might have a much more abrupt slowdown than we, especially me, are thinking. Now, some of these names have underperformed for quite a bit. United Parcel, for example, seen the stock fall 14% for the year, with a precipitous drop in the last month, 150 to 134 and change. That, to me, is worrisome. Trucking giant J.B. Hunt. It's down 20% for the year, thanks to multiple points of weakness when it last reported. Intermodal down 9%, contract services off 2%, integrated capacity solutions off 26%, truckload, where revenues declined 13%, operating income had a 75% nosedive. That is terrible. How about the ugly action in the rails all of a sudden? This normally robust group has been smacked down hard. CSX and Norfolk Southern down 6%, Union Pacific off 9% for the year. These are relentless, grinding downward moves, and they don't seem like they're stopping anytime soon. When you compare that to Apple or Broadcom or Adobe, I mean, geesh. Fourth, we witnessed a sudden precipitous decline in the food and beverage group. The very reliable Molson Coors, symbol TAP, has gotten clobbered, falling over 17% for the year. It just dropped from $69 in April to $50 and change. Today, hitting a 52-week low today. Kraft Heinz is down 12% for the year, back yielding 5%. PepsiCo, which is not known as a wild trader, right? It's gone from 183 a month ago to 163 today. I mean, that's just unnerving. Oh, and obviously there are stocks like McDonald's, which has fallen from 302 in January to 253 and change today, just 8 points up from its low in October of last year before the Fed's big pivot. It joins the likes of Starbucks, which is off over 14% and for the year and can't seem to get any traction. The restaurant cohort has been very disappointing, aside from some extremely positive exceptions, Chipotle, Wingstop, Domino's. Today, the bears even got to aerospace as GE got smacked, declining more than 3%, thanks to a number cut from J.P. Morgan related to supply chain issues. Boeing was thrown back for a 1% loss, but Boeing always seems to be thrown for a loss. Problem is, I'm not cherry-picking here, people. Those are the largest sectors in decline. I could have widened my net to include oil and gas, retail, non-pharma healthcare, drugstores, entertainment. These are all very weak sectors, but weaker for reasons that are understood. Numbers are either bad or starting to roll over. Their stocks cannot hold these levels if numbers are being cut. Lots of landmines. So understand, it's not that the market needs to broaden out. It's that buyers can't. They're afraid to go. The buyers are afraid to broaden out. It's too risky. Too much uncertainty away from tech. Too much certainty in tech because of the coalescence of accelerated computing and generative AI. Because of what Jensen Huang has told us. He's the CEO of NVIDIA. Here's the bottom line. Ask yourself, without the AI-related tech names, where would we be? But more important, if you sat them out because you waited for the rails to catch fire or the foods to catch fire or the banks, well, you've missed out on some major gains, and that's our job, is to find them. Sometimes you just have to accept that it's worth trying to make money in a market that has some really bad breath and no mouthwash in sight. Let's go to Bill, Massachusetts, please. Bill.
Oh, yeah, Jim, how are you today?
I am good, Bill. How are you doing?
Can I just take 30 seconds and talk about the club, Jeff Marks, the morning meeting, and you?
Sure, that'd be nice. You know, I didn't put you up to it. I'm thrilled that you mentioned it. Thank you.
It's all me. I wanted to give a special shout out to Jeff Marks. He's coming into his own. He keeps you grounded in the meetings. I love how you guys bounce things off each other. Today's meeting was great.
Well, thank you. That is what
coming into his own.
Bill, thank you. Jeff and I sit next to each other, and what you see is what we try to do for the club. The whole day we're doing that, back and forth, including for Broadcom, which we had and was terrific, but for Starbucks, which we had and was miserable. So we go over the good and the bad. Now, how can I help you now?
Well, Jim, I've been doing my homework on this company. I feel very bullish on American Express. Please give me your opinion.
I like American Express very much. I was sad to see it downgraded the other day. I don't think it should be. I think Steve Squeery's doing a terrific job. The stock's 22 points off its high. That makes a lot of sense to me. I know the chart looks terrible. I think that's driving a lot of the downward momentum. I think you buy some and then you wait 10. And I'm going to tell Jeff's watching the show, and I know you're going to make him feel great because he is great. He's just a terrific partner. Anyway, look, sometimes you just have to accept that it's worth it to try to make money in one particular group, even if there isn't participation away. We must always be opportunistic, people. If you've been sitting out the big tech names in hopes for a broader rally, then you've missed some of once-in-a-lifetime gains. Well, man, by the time Signet Jewelers reported light sales, sending the stock lower. But could an uptick in engagements be an opportunity to get in on this name? I'm chatting with the CEO, and it's really a forecast that's lighter. I thought the quarter was pretty good. Then I'm continuing my series on healthcare stocks by seeing if Pfizer could be poised for a comeback after its pandemic peak. And later, I'm checking in with Adobe CEO to hear where the software stock stands in the competitive digital design space that I think they dominate. It's after a big earnings beat. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Did the stock of Signet Jewelers deserve to lose 15% of its value today? Going into the quarter, this stock was up more than 80% over the past year, thanks to recovery in engagement ring sales, which finally started bouncing back from the pandemic. But this morning, Signet reported 26-cent earnings beat off of an 85-cent basis, paired with slightly weaker than expected sales, but then gave lackluster guidance for the current quarter. Plus, management left their full-year forecast unchanged, which implies the rest of the year is not so hot, because they just reported a sizable earnings beat. In response, that's why the stock plunged 15%. Could it be an overreaction? Or do we need to get a little more worried than I have been for some time about this stock? Let's check in with Jenna Drozo. She's the CEO of Signet Jewelers to get a better read on the quarter. Jenna, welcome back to Mad Money.
Hi, Jim. Thanks for having me.
Oh, it's great that you're here. You can shed some light on things because there's this kind of like a valley of the shadow of death, then snapback thing you're predicting. This quarter good, then a little bit dip, and then don't worry because the second half will be great. And I just need a little more confidence because I know last time the stock got hit and it just then soared. I'm wondering if the same thing can't happen again.
Well, I think the key message on the quarter, Jim, is momentum. All of retail saw a sluggish start to the first quarter in February, but we began to rebound after Valentine's Day. We saw that continue through March and April with an even stronger May. We're still holding our increased full-year guide. We raised that in April, 9 to 10% on EPS, and that guide includes our belief that the business will inflect to positive same-store sales growth in the back half.
Well, if that happens and you do what you talked about, or your CFO talked about, which is possibly buy in all your preferred, you have a lot of firepower beyond that. This may be in a situation where, like, a week from now, you can say, look, we're going to do all these different things because we have excess cash and earnings per share may turn out to be light. That could happen, right? Your forecast could be lower than what would happen if you bought back the preferred.
Well, we definitely have cash on hand to buy back the preferred. As you know, cash has been a very strong story for Signet. Our balance sheet is healthy. Our working capital is healthy. We've generated free cash flow over $600 million each of the last 4 years. We've reduced our debt by 70% versus pre-pandemic, and we have the cash available to be able to take out the preferreds, which it's our intention to do before the maturity date.
All right, good. I don't want to get too stuck in the weeds, but I want people to know that this may be a short-term blip down because of the way that you can that you have the financial firepower to take care of things. Now, I do want to get into this notion of the what you actually called the heightened competitive discounting in jewelry. Now, when did that start happening?
Well, we've seen independent jewelers be over inventoried. So, a lot of the impacts of COVID were pretty easy to predict. One that wasn't as obvious was that because of lockdown, people would stop dating. And so therefore, multi-years later, 3 to 4 years later, we would see a lull in the number of engagements. Our data analytics, our consumer insights are proprietary, and we did predict that. That's why our our inventory has been so healthy, but a lot of the industry didn't. So for the last year, independent jewelers have been over inventoried, and the level of discounting has been significant. Now, that said, we have a number of strategies to mitigate that kind of pressure on our business. One is to bring significantly more newness to our business. We've done that in both bridal and in fashion. And I talked on our call today about how we've seen engagement unit trend go up by 400 basis points in the quarter. And we've seen the fashion same-store sales go up. That trend has changed by 500 basis points over the last 3 months. So we're seeing broad-based momentum in the business based on that strategy of newness. Not only that, we also now have a loyalty program so that we can target our value propositions to customers better as opposed to making them broad scale. And our services business is a fantastic offering that's also a high margin business for us.
Okay, how much of your revenues is the extended service plan?
Well, we don't talk about percentages of the revenue, but what I can tell you is that it's a fantastic add-on purchase for people who are buying engagement rings or higher priced fashion. In fact, 80% of the time that we sell an engagement ring in store, someone purchases our extended service plan because it offers a great value to our customers.
But at the same time, if I want to be able to get a lab-created diamond, I probably don't necessarily want that service plan.
Well, we're not really seeing consumers distinguish that way. The service plan covers much more than just the diamond. So a tightening of prongs, if you want to, go in and have the diamonds checked to make sure that they're fitting exactly right. Resizing is something that our service plan would take care of. So these are things that consumers are interested in, whether they buy a natural diamond or a lab-created diamond.
So a lab-created diamond, let's say it's great. They've grown tremendously. So we all want people to have a chance to have a diamond. These are diamonds. Is it good for Signet or bad that they've now taken about 50% of the market?
I think our diamond strategy has been working very effectively. We saw that work very effectively in the first quarter as well. And that is that lab-created diamonds can offer the opportunity for people with a challenged budget to be able to get a larger or stone with a higher color or clarity. In that case, though, we most often see people trade up. So the average transaction value on a lab-created engagement ring is higher for us than on a natural diamond engagement ring. But the really interesting story is in fashion jewelry. We said on our call today that our lab-created fashion jewelry was up 14% in the first quarter at an average transaction value more than double the balance of our fashion merchandise. And so that's a significant opportunity for customers to trade up into something with a bit more bling.
Well, look, I think you're making the best of both worlds. I do think that there was an overreaction today, particularly because you've been such a great steward of the balance sheet, not just the business. I want to thank Signet Jewelers, CEO of Signet Jewelers, for coming on. Signet, you always give us a great perspective on everything. Thanks so much for coming on.
Thank you, Jim.
Okay, Mad Money's back after the break.
Coming up, known for major patents, Pfizer has rewarded investors for decades. What's in the pipeline for this household name? Stick with Cramer.
All week, I've been recommending my favorite big pharma stocks because this group's exactly what you need if we're headed for an economic slowdown. And with the Fed planning to keep rates higher for longer, but just one rate cut this year, or maybe fewer, who knows, I think a slowdown seems pretty likely. We went over all the commodity price declines that we've been seeing just last night. So far, I've given you 3 high-quality drug stocks that are trading at or near their 52-week highs. AstraZeneca, man, I really like that. Merck, and we've had Rob Davis on. He's fantastic. Novartis. Vastner Simon just went over his last night. Good, interesting story. Tonight, I want to take a different approach. It's arguably the most hated stock in big pharma. That's right. I'm going to talk positively about Pfizer. Can you believe it? This company was one of our saviors during the pandemic. They developed one of the two major COVID vaccines with the help of BioNTech, along with Paxlovid. That was the closest thing we have to a cure. Just those two products have given Pfizer more than $100 billion in sales over the last 4 years. Now, to put that in perspective, this company had $42 billion in sales in 2020, which jumped to $81 billion in 2021, before peaking at just over $100 billion in 2022. But then we started getting over the pandemic, and Pfizer's sales came right back down, along with its stock price. After falling to $26 thanks to the COVID crash in March of 2020, the darn thing charged to an all-time high of $61 and change at the end of 2021. Since then, though, Pfizer shares, what can I say? They've collapsed, coming down to $27 and change now after a 44% decline last year. It's basically erased the entire run. So what the heck do we do with this stock? How did Pfizer go from pandemic-era darling to seemingly the most hated stock in pharma? We know what the plan was. Pfizer was going to put its COVID cash to work, buying assets that would represent the future of the company. And they do need new assets, by the way, because their COVID sales have evaporated and because the company's got some major patent expirations coming in the not-too-distant future. That's why it doesn't look – it looks like it's cheap, but you have to be careful about these things. From this year – this is pretty amazing. From this year through 2027, Pfizer's got 6 blockbuster drugs, current ones, that are going generic. And you know how much they make almost nothing on a generic. And that includes Eliquis, their blood thinner that did $6.75 billion in sales last year. It loses patent protection in 2026. Their best-selling cancer drug brought in $4.75 billion last year. It loses patent protection in 2027. Their best-selling specialty care drug put up $3.3 billion in sales last year, and it comes off patent in a little over 6 months. So Pfizer's got to work. He's got to make some deals, announcing 6 small to medium-sized takeovers in 2021 and 2022. In 2021, they acquired Amplix Pharmaceuticals. That's a privately held biotech with an early-stage antifungal drug for an undisclosed sum. Then they paid over $2 billion to buy Trillium Therapeutics, a clinical-stage oncology company focused on blood cancers. In 2022, Pfizer did 4 deals. They spent $6.7 billion to snap up Arena Pharmaceuticals. That's a clinical-stage company developing treatments for immune inflammatory diseases. Then they bought Reviral, which was working on antivirals for RSV in a deal worth up to $525 million between upfront payments and milestone payments. Then they brought Global Blood Therapeutics, a specialist in rare blood disorders, including sickle cell disease, for $5.4 billion. And Pfizer also directly purchased a couple of drugs, including Biohaven Pharma's migraine treatment known as Nurtec ODT, which cost them $11.6 billion in a unique deal that let Biohaven's management team keep the rest of its pipeline as a newly spun out business that's called Biohaven Limited, and that trades now independently. Finally, last year, Pfizer did its biggest deal yet. It shelled out $43 billion in cash for Seagen, which already had 4 cancer treatments on the market at the time of the deal, and I always really liked that company. Spoke to them many times. They just completed the Seagen transaction in December. So what went wrong here then? Well, first, Pfizer's COVID sales tapered off much more quickly than anyone expected. Now, this started to become apparent in late 2022, when people would have been getting their COVID shots in the fall, except not that many people showed up. Pfizer COVID-related products ended up a disappointing quarter after quarter. It's just been wrong. Management originally projected, this is what's really bad. They originally projected $21.5 billion in COVID product sales in 2023. The actual number turned out to be just $12.5 billion. Man, was that awful. The worst part, this was death by 1,000 cuts, with each successive shortfall doing more damage to the stock along the way. Other than the collapse of the COVID business, Pfizer's been hit with a series of disappointments from both its own drugs and the ones it's acquired in recent years. For example, I've been following this Nurtec ODT for ages because I get migraine, and I am the spokesperson for the American Migraine Foundation. I think it is a miracle drug. Popped one the other day when I thought it was going to rain. No pain 5 minutes later. So I was shocked by the slow ramp after Pfizer acquired it in late 2022. Even as a small independent company, Biohaven achieved excellent growth from Nurtec ODT. I figured Pfizer's gigantic global sales apparatus could supercharge its growth. Didn't really happen. But the company's finally given the drug marketing that it deserves, and I think those numbers are going to go up big. Now, I don't know how big Nurtec can ultimately be, but I think it can help bridge the patent cliff for certain, and I don't think that's in the stock. Some of the other takeovers have also been slow to produce results, though, which became more of a problem as Pfizer's COVID products dwindled. As for the homegrown stuff, Pfizer failed to advance its GLP-1 weight loss drug candidate from phase 2 to phase 3 trials because of gastrointestinal side effects. Oh, and just last night, Pfizer's gene therapy for Duchenne muscular dystrophy, DMD, failed to hit the primary endpoint of its phase 3 trial. Again, disappointing. So why the heck then would I recommend Pfizer on this show as one of my best ideas in pharma? All right, a couple of reasons. Needless to say, it's a very contrary view. But first, the business finally does seem to be stabilizing, as estimates for COVID sales have gotten low enough that they reflect reality, meaning no more constant disappointments. When Pfizer reported its latest quarter on May 1, it was actually strong, with a sizable revenue beat and a huge 30-cent earnings beat off of a 52-cent basis. Management also raised their full-year earnings forecast as they've gotten very aggressive about cutting costs. Just 3 days ago, Pfizer CEO Albert Bourla said that he's, quote, very confident, end quote, Pfizer will make its full-year forecast. Second big reason I like Pfizer, they just picked up the Seagen's excellent cancer franchise. Yes, Pfizer paid a lot for it, but I think the price was worth it. Frankly, I'm surprised Biden's aggressive antitrust regulators let this deal happen. But they did, and now Pfizer can dominate the incredibly profitable oncology business. This is really a good property. Third, and most importantly, I think the bad news at Pfizer is baked into the stock at last, now that it's trading 27, down 55 from its peak in late 2021. At these levels, it sells for less than 12 times the forward earnings estimates. Oh, and remember, those estimates take into account all these patent expirations. Oh, and Pfizer's paying you to wait, generous 6.1% dividend yield covered by the cash. Honestly, it's absurd that the stock would go this low with such a safe dividend. What makes me so confident the downside here is already pretty limited? Look at what happened today. Remember, Pfizer issued another disappointing clinical trial result last night. As a result, seemed natural. The stock opened down 1.7% at its lows this morning. Exactly what you'd expect, right? But then it turned around and finished the day off just a penny. Doesn't that feel like a bad news bottom to you? So here's the bottom line. Pfizer is not one of the best operators in pharma, but it's definitely among the best opportunities. Those are two different things, but they can both pay off. The company's coming off a tough couple of years, but now with the stock barely above its March 2020 lows, I think Pfizer is simply too good to ignore, especially as the company gets its house in order and we start seeing the benefits of the tremendous Seagen acquisition. Let's take calls. Let's go to Dexter in California. Dexter.
Jimbo, how are you, sir?
I am doing well. How about you, Dexter? What's going on?
I just came back from the country. I was in South America visiting my boy in Brazil and Argentina, but I'm happy to be back. I missed you.
Oh, I'm sorry. You can't get me down there. That's just, you know what? You can get the Eagles when they open the season in Sao Paulo. All right?
You sure can. But when you turn on the TV, you just don't get mad money, so I missed you, man.
Thank you. Sure.
I have questions. Listen, I'm calling about a stock you introduced to me on your show probably a few months back. They're a pharmaceutical delivery company. They've since broadened their products to include compound GLP-1 injections, which are cheaper than Lilly's and Novo's, if you can get those versions. Stocks move nicely, though. Looks like it wants to keep moving. What's your opinion on him and Hers Healthcare?
Well, that thing is a rocket ship. I don't know. I mean, I think that the last 10 points may have been a short squeeze, and I don't know when a short squeeze is going to end, which is the problem. I don't think it's necessarily trading on the fundamentals right now because it's trading, it's a very expensive stock on the fundamentals. But if the short squeeze is maintained, this stock goes still higher. But I can't give you, first of all, welcome back to the country, but I can't give you a definitive look about what to do because I think it's the short that's controlling the stock, not the fundamentals. But thank you for mentioning we did talk about the stock when it was lower. Anyway, look, Pfizer isn't like our top ideas. It's not like the other guys. It's not AstraZeneca. It's not Merck. It's not Novartis. But you know what? The stock is priced too low for what Pfizer really is. And therefore, I think the stock represents a good opportunity at these levels. Much more mad money. I'm talking AI advancements, and more with Adobe. Holy cow. Top brass right off the earnings report, which is pretty good. Then an IEA report yesterday warned of an end-of-decade oil excess. So where do I stand on the future of energy? I'm drilling down on the news and giving you my take. And, of course, all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. Did the market get too negative on the stock of Adobe, the digital media and marketing software kingpin? People have been questioning the value of traditional enterprise software in a world where it's very easy to ask computers to do things that you thought you needed expensive software for. That's in part why Adobe stock had tumbled from 638 at the peak in February down to 458 at the close tonight. However, what we got tonight from Adobe was a sharply better than expected quarter and a fantastic forecast, and the stock's flying in after-hours trading. So what comes next? Let's take a closer look with Shantanu Narayan. He's the chairman and CEO of Adobe. Mr. Narayan, first of all, congratulations on an amazing quarter, and welcome back to Mad Money.
Thanks, Jim. As always, great to be on your show.
Well, Shantanu, I've got to tell you, this was a remarkable quarter, a great forecast boost. And I just want to ask you, how do you think that the market so misjudged Adobe, the company, and all the amazing features that you get when you take your product?
Well, I think, Jim, there's been so much focus around AI and infrastructure and chips. And rightly, I would say, people have been seeing a lot of spend in that particular category. But at the end of the day, at Adobe, we're completely convinced that it's the interfaces rather than the models where the real value is for customers. That's where they're going to be performing their tasks. That's where they, better their workflows. And if you want to do creativity or if you want to do marketing, that's where Adobe comes in. And so we've always said we've embraced AI. We think it expands our market opportunity. And I think there's been more questions around, does AI replace these folks? And I've always maintained it's actually people who use AI who may replace people who don't use AI, and there's no replacement for human ingenuity. So this is playing out as expected for us, Jim.
Yes, and this is really the most important point. It was right up at the top of your statement when you said Adobe's highly differentiated approach to AI is rooted in the belief that creativity is a uniquely human trait, and that AI has the power to assist and amplify human ingenuity, but it's a human trait, and people don't seem to understand that.
Well, Jim, I think it's our job at Adobe to continue to show how our products can be made more accessible, how people can be more productive when they have this incredible creative idea that they want to communicate across any campaign or media type, that through products like Photoshop or Adobe Express or with our models like Firefly, where we saw over 9 billion generations to date, that's really the magic of taking what's in somebody's head and making it available, as a campaign, as a flyer, as a video. And so, we don't worry about the short term and how the market might view it, because we realize that any time that you can get more people into the platform, any time that you can deliver and delight your customers, good things will happen.
Right, now, there's been this so-called existential threat from an outfit called Canva, which has a good product. There's no doubt about it. But I was tinkering with Adobe Express. You pushed some stuff last night. It was really fabulous. And my daughter and I were doing it. We just said, look, you offer a much better free alternative than the paid alternative of Canva. That's what the new stuff is offering. So we don't understand the dilemma. I have to believe the pickup of Express is extraordinary in the short time it's been out.
Well, I think what Adobe Express and the Adobe Express business event that you're talking about, these were big milestones for us. We completely redeveloped Express, both across mobile and across the web. And the products are incredible because we believe that it's a leapfrog in terms of how they actually use AI to be able to accomplish your task. And so, for a long time, we're a product company. We were focused on the product. And now we're going to pour gas on the go-to-market and how we get more awareness of the product, how we get it out in the hands of more people, how we continue to leverage the incredible inside sales that we have, the enterprise, certain traction that we have to make sure that people are hearing a lot more about Express. So I think the product is phenomenal, Jim, and now it's all about the go-to-market.
Now, how about the existential hit that you got when this Sora came out? I mean, we looked at that, absolutely. It's great, but it's basically a product that is fun, okay? It's a fun thing to fool around with. But you're the gold standard. When we looked at Sora, all we could say was, hey, you know what? If you don't want to fool around with creativity, if you want to outsource creativity, maybe you give this a try. But if you want to be creative, which is what I think you and I know is the essence of Adobe, there's really no comparison.
Well, if you take a step back, Jim, and think about, what these models are able to do, the models are able to absolutely accelerate ideation. Which is you're just starting off, you want a little bit of video to jumpstart the process. All that means is all of these models, and they're all going to be personalized in different ways. Our image model might be different from Sora's in terms of, the personality that they have, but it's going to create more content, and all of that content will have to be edited. And that's the belief that we have. we invented and we created Firefly because it was really important for Adobe to understand how these models worked, how hallucination worked, how we could do it in an ethical way, how we could do it in a responsible way. But we've always also said, and we've actually demonstrated at NAB, where on the video side, whether it's Sora, whether it's other models like Runway ML or Pika, the power will really be in enabling all of those within our editing applications, and they may have different applicability for different use cases. But if you want to do that color correction, if you want to, transition the video the way you want to, you still need an editing application in order to be able to do that. And so I think while the attention has been on this model creation, the value will eventually accrue to the interfaces and what people use to accomplish their task.
And I think to go a step further, I know there are people who will listen to you and they'll say, but wait a second, there are these cheaper alternatives. But if you go to any school in the country, nothing has changed. Every major design school in this country did not flinch. They're all Adobe. I felt that the newer things that you're going to bring on will make it so that people who aren't at the design schools will go to Adobe and not others because they are very accessible. So you've decided, I think, to make a free part of Adobe for people who don't really know how to use even computers.
Well, I have, and the company has always had a passion for education and the education segment, Jim. I mean, I used to say growing up that reading, writing, and arithmetic were the three skills. You have to add creativity to that particular skill. So ensuring that Adobe is focused, whether it's a K through 12 student or whether it's the best design school in the world, and making sure that we work with them, we get their feedback, we understand what's on the minds of that next generation creative is really important to us. And so, we're thrilled with the engagement and the partnership that we have with those schools, but it truly is a passion for us at Adobe to make sure that the education segment in particular is both embracing and partnering with us for us to be able to deliver the most innovative products.
Well, Shantanu, I've got to tell you, this is a remarkable quarter. Obviously, things are just getting stronger as the quarter went on. And I really want to thank you for coming back on Mad Money. And I knew this was going to be a big quarter. Just a job well done, sir. Fantastic work.
Thank you, Jim, and thank you again for having me on your show.
Of course. That's Shantanu Narayan, Chair and CEO of Adobe. Even with up 75, believe me, you're in good shape for this one. Mad Money's back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.
It is time for the lightning round. That's very cool. My partner, Shane, stock is totally buy, sell, Jim Cramer. Do not know the core stock. I don't know my staff basically you plan to sell. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Cramer, this is my show with Penny in California. Penny.
Jim Cramer, thank you for the knowledge and the encouragement you provide.
Well, just out there trying. Thank you. I'm sorry?
I want to know if Novacure NVCR is a buy, sell, or hold.
Well, they should. I've featured them many times, and I've got to tell you, I was hoping that they would start making money, and they don't make money. And at a certain point, I made a decision on this show that I was not going to recommend stocks that lose hideous amounts of money. And I am not changing my mind. I'm not going back on that. Let's go to Kevin in Arizona. Kevin.
110-degree Arizona. Booyah, Jim.
Booyah, back at you. What's going on?
So about 3 years ago, I picked up some PayPal, now my largest holding by far, 22% down. But I have confidence in Alex Chris and his team doing my homework. Should I hold it until it gets to my cost basis of 80 or sell early?
Well, do you know I was going to say the same thing? I said, since Alex Chris has come in, I've gotten renewed faith in PayPal. I know that there's a lot of competition, but this gentleman seems like he really knows what he's doing. I would hold on to it, but I wouldn't want to buy more until I see better numbers. Let's go to Alex in New York. Alex.
Booyah, Jim.
Booyah.
Since NVIDIA's Blackwell requires 100% liquid cooling, wouldn't HPE be a winner going forward given their liquid cooling advantage?
100%. And I've got to tell you, I was, until I saw this quarter, I did not know how well they're doing. I think it is just a terrific situation. I know I was going back and forth with my friend Herb Greenberg, who's got this Wall Street Beat said it's kind of a really cool thing that he does. He used to work with me at the Street. And they have a lot of positive commentary about Hewlett Packard Enterprise. I think it does go higher, even though it is at a 52-week high. Let's go to Max in New York. Max.
Booyah, Jim.
Booyah.
So I called you on May 6th about AeroVironment, AVA.
Okay.
Wanted to know if I should continue holding it. I know that they're going into earnings at the end of the month.
Well, it's had a very big run. Now, we do know that President Biden was over in Europe, and they're talking about, obviously, there's a new deal. AeroVironment's going to get more money, I believe. It's an expensive stock, but I would hold on to it. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, what will Elon Musk's pay package mean for Tesla's ability to compete? Start your engines with Mad Money. Next.
Will there really be a staggering surplus of oil by the end of the decade in this world, as the International Energy Agency said yesterday? Now, this organization does pretty rigorous work, and they say that we'll have 8 million barrels per day of spare capacity because of reduced demand as the world goes electric, the Middle East switches to renewables, and the Chinese economy is slowing down. Now, if you read this report, you'd think that the world's gotten religion on global warming, that the entire globe's turned against fossil fuels, and there's nothing the oil companies can do about it. To me, this is pure wishful thinking. We aren't selling nearly as many EV cars as we were not long ago, and the market's not growing as most expected. Hybrids are in vogue in this nation now, not pure electrics. We know that two candidates for the president have very different attitudes toward the fossil fuels. So I think this IEA forecast, it may not be accounting for the White House possibly changing hands. Now, if we allowed Chinese cars into this country without tariffs, instead of the 100% tariff we're putting on them, electric vehicles would be much bigger here. But that could be a huge threat to the American auto business. They would take over Europe, too, if it weren't for the EU's 38% tariff. They just slapped on most Chinese cars. The average price of a Chinese electric vehicle is about 10 grand. My wife just came back from Italy, where she drove in a $10,000 sedan from China and thought it was every bit as good as a Tesla. Now, you might say, well, that at $20,000 with the 100% tariff, it may still be worth it, and it would be the standard beer here. But you know what? If that starts happening, I think our government will just raise the tariff again. Our government wants to protect the American auto industry. It's not like Tesla can bring down the price of its sedan to match even the tariff prices of Chinese electrics, no matter what what happens with his contract or what he can do. He just can't. And while I've been consistently bullish on the future of the oil industry, and I remain that way, I think it's possible that we pretty much reach peak output here. We're beginning to run out of new sites to drill, even in the oil-rich Permian Basin. Now, on a day where we saw the producer price index come down, I will say this. If the IEA is right about oil, we could have dramatically lower inflation. We already know oil will be cheaper if not for the war in the Middle East and the war in Ukraine. Crude's now at nearly $78. And if the world were at peace, I think you could easily imagine it in the low 70s or even in the high 60s. Second, OPEC Plus only controls about 48% of the market these days. If demand shrinks the way the IEA is projecting, then OPEC would be powerless and the price of crude could be just down dramatically. But I don't see that happening. The supply situation may still be perilous. And amazing, the discipline of the U.S. drillers is just plain shocking. When oil shot up this year, the U.S. producers did not ramp up production. They kept it steady. There was a time when they'd be pumping like mad to get these new prices. So we can hope that there will be an oil glut, which would be fabulous for inflation. But as I see it, the IEA report is merely wishful thinking. There's just too much resistance to free trade with China to make it so electric vehicles are cheap enough to be widely popular in the developed world, even as China will surely be using less carbon itself because of these cars. If we take China's cars in at the Chinese government's subsidized price, again, I have no doubt the IEA report will be correct. But the only thing Trump and Biden agree on is the need to stay tough on China. So my bottom line, I say, don't hold your breath. I like to say there's always a bull market somewhere, and I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.